Hey, what's up? What's up, Dealmakers? How's everybody doing? I'm in Las Vegas. It looks like my man Will, my co-host Will Wall, is already in the building. Also in
Oh,
Vegas, in a different part of the hotel. We're in the middle of a conference, right? So we're making it happen. Still bringing to you an amazing interview today with Max Gonzales. Will and I are both good buddies and fellow students in the Future Flipper coaching program. We're going to talk about multifamily today. You excited or what?
should be exciting. I know I've seen a lot of folks that are usually on the call out here at the mastermind, and everybody was really excited to hear that, even though we're at the mastermind, we're still taking some time out and getting this webinar up. So I know some folks will be excited to see the recording of this once we put that on YouTube as well. That should be really, really helpful for folks. I know multifamily, Alex, right? We've obviously, dabbled into some multifamily with our investment property out in Arizona. So like you mentioned, I think this should be a great chat today with Max, kind of going over some of the finer, pieces about investing in multifamily. It is a different asset class, and, with different asset classes come different investment strategies and techniques. And I think he is a, really smart dude and has a wealth of knowledge in this, in this space. So it should be great to bring him on. Before we do though,
we a lot of times we're interviewing people here, right, for our own selfish reasons, and this would be one of those cases where Max and I have worked closely together. Especially he wholesaled us our AT unit, and we'll be talking about that deal a little bit in this conversation, in this interview. But I think what I'm most excited about is that value add multifamily is essentially flipping houses, but on a much bigger scale. So in a rising interest rate environment, like, we need to share with everybody like what's happening, how we're making adjustments, because there are a lot of changes happening both in single family and multifamily. And then Max is going to be able to shed some light on the multifamily for all of us to learn and to be able to take action based on what he's seeing, right?
Yeah, like I said, I'm excited. It should be a great call. And in the meantime, guys, if you get a chance, if you can, go ahead and use the chat feature. It's going to be right down here at the bottom of the page. Just go ahead and chat in. Let us know where you're tuning in from. What kind of investment strategies you're doing. If you're doing multifamily already, let us know. If you're doing single family, and then let us know where we can connect with you. If you're on Instagram, let us know your handle over there. That way we can kind of, stay connected with you outside of the meeting today. Alex, before we do bring on Max, I know we usually like to just kind of catch up, see what's going on with you on your end. So what else is kind of new outside of being out here in Vegas for the Future Flipper Mastermind?
Yeah, so a couple updates. So we've recently sold a couple of our properties. So we're in the process right now of reloading, just kind of re-upping, getting the inventory sold that we bought before the market kind of shifted and started to slow down back in June. And so we're seeing a lot of that. We're still selling houses. We're getting the prices that we anticipated, but it's taking us longer to sell those houses. So every time that we do, it feels great because we know that we're paying off our hard money lenders. We're paying off any private lenders if we did raise capital for that particular deal as a private lender. And then we are now going back to the drawing board and buying property at a much lower discount. We're taking a little bit more off the ARV. So we sold a house in Mojave, and it was funny because a couple months ago we wouldn't have gave people credits, any of that. We wouldn't have given extensions on escrow, but we're seeing that, right? We're kind of getting beat up a little bit as a seller right now, which to me on the buyer side, it provides an opportunity, but it doesn't feel that great when we're having to, put up with delays and other stuff. So that one got to the finish line. So I'm happy about that. We finished off, we're going to be doing a kind of like a headquarters, kind of second home for myself in Antelope Valley. We've kind of branded ourselves as Antelope Valley buyers because we bought 15 plus properties in the last year or so in Palmdale, Lancaster, and the surrounding areas. And so we're doubling down on that by having a headquarters there, a home office, a second house for me while I'm in LA. So it'll be one of those places that we could, be productive. We could also join together and, have good time there as a team, and whoever else wants to help in getting more acquisitions and more business in this particular part of Southern California that we're in. So I'm happy about, I had a designer help me with that property as well. And we're gonna do some cool stuff with it, like an above ground pool, some cornhole, jacuzzi, just kind of like a office compound almost, like, because people that haven't been to the Antelope Valley or have been there understand that it isn't the coolest place, no offense to anybody, in Southern California. There's a lot of other places with more to do and stuff. So, but that also gives us more opportunity for us because there's less talented people and all that. So that's a big win for us. Also, we are currently now in the Rampinator Future Flipper Mastermind. So we're literally in the hotel room while the event is happening downstairs. We just took a quick break to come up here, do the webinar. And then I'd say the biggest win though really is that we hosted our largest real estate investor event last week. Thankfully, it went off without a hitch. It was better than all of our other events. We had over 300 people register. We had over 270 people actually attend the event. And I think people got tremendous value. We talked a lot about the creative finance, how that's going to be a big piece in the future because there's so many people with sub-3 interest rates on their mortgages. So we're seeing that creative finance, seller finance, some of those strategies are going to be amazing tools for investors to use right now. So we talked a lot about that, and it was a good old time. So that, and then lastly, I just spent some time with family and friends over the weekend. So it's time to finish out this mastermind here in Las Vegas, interview Max here. I'll give you guys some value on everything he has to say regarding multifamily. And then I'll be back in LA tomorrow with you and back at it.
Good stuff, man. I know the meetup, obviously that was super fun. I see Alexandra in there, just chatting back, like how awesome of an event it was. And thanks for putting it on. So, like you said, Alex, like we're doing that event for the deal makers, for the tribe, for the people that we're doing deals with, and the people that we think are going to be able to do deals and be a valuable part of our group, right? So I think everybody there, whether they were a newbie, whether they'd done a deal, got some sort of value from it. So really thankful again for our entire team, really putting it together and making sure that event was a success. Obviously, you and I are up there on the stage, but big kudos to our team members, Abby, Mikey, Lily, all the guys on the virtual team that just did a phenomenal job of putting on that event with us. So, again, I think the event was great. And I think today we're going to have a great conversation. We're going to go ahead and bring on our guy, Max Gonzales here. I know Alex, gave a little introduction and, we're in the Future Flipper program with Max. That's allowed us to kind of, become closer and better friends and business partners with Max now as well. And so again, we're really thankful for him being able to take out some time of his day and come out and join us, right?
Yeah, man. So he currently leads the acquisitions and investor relations for Geometric. I know he works with Conrad, his partner, and they're studs. He's been actually in the multifamily business now for a good part of almost 20 years now. So he did work for other bigger companies. He worked as a buyer, as a broker, and also buyers and represent buyers and sellers in multifamily. And he's also, worked in other states other than, Southern California. He's active in Arizona where, we've done a deal together in Nevada, but he's helped acquire, over $85 million in assets. And he's also led acquisitions for other investment companies with $9 billion of holdings. So Max is wickedly smart. And he's definitely somebody that we push to get out there a little bit more on social media because he's definitely behind the deals and looking at deals and constantly making offers and putting deals together. But I think recently also he's taken on because in these bigger deals you got to raise capital. People, you got to help other people's money needs to come into place to be able to take these big deals down. And you're kind of the orchestrator of all that. And Max has been that, but now he's going bigger. He's doing a bigger deal, so he needs to get out there and get more exposure. And so we push him on that. We hold him accountable a little bit on that, which is cool. But hey, what's up, Max? How you doing, buddy?
Alex, I'm so glad to be here. And, and I appreciate all the words of praise. And I got to tell you, every time you do everything you're doing, the webinars, the meetups, any of the, sorry, I'm getting my light here, right? Any of those things, it's really inspiring for me because as you've mentioned, I've got a lot of knowledge for multifamily, but man, I joined certain networking groups to be, connected to guys like you and Will, because you guys are doing a phenomenally better job than I am at, running a full business with lots of staff and doing all of the marketing, doing all of these things that, really was a new thing for me to learn. I had a lot of, multifamily market knowledge and, analysis knowledge and execution knowledge on the real estate itself. But, I've really learned, a ton from you in regards to how to, really structure a company, which is really a different part of the business that we all kind of learn as we get into this stuff. So super stoked to be here and super stoked to share as much knowledge as I can within our time set for this call and for all of the people who are watching who got questions. And so a little bit of background, on myself. I've done large scale acquisitions, which is, I'll call it small to large scale for multifamily. It's always been my core focus, but I've placed money for pension funds, for some billionaires and some other groups where we're, buying deals between, I'll call it 35 million up to about 150 million in size. And in those assets, while they're big, it's funny because, in the business, we learn about, using other people's money, and with these bigger transactions, they're a lot of it's a team sport for multi. And, hear about this more and more, but it's generally a team sport. And we were talking about this a little bit before the call, and I should have gone into this a little bit more in detail. But within multifamily, there's generally going to be, a partnership that's going to come in between, the individual who finds the deal, the individual who's raising capital for the deal, who's overdoing the asset management, construction management, who's got at-risk capital. And, and within these pieces, the deal is going to kind of be split up among the teams. And if you've got a really well-oiled machine that can do all of them, then you get one whole group that can take the whole deal down. But we find as we are in this business that generally there's still kind of a partnership that comes up. And we find that, a lot of us, we'll tie a deal up and we'll immediately call our, closest partners, guys who are in the industry, who can either fill one of those, player spots on the team. And those player spots, what we're doing within each of those is we're making sure that we can, have the deal run effectively for our investors and ourselves. But we also want to make sure the investors, equity is protected, and we want to make sure we go through a pretty deep amount of analysis, and that's where I'll call it my background. And, my biggest weakness is, a lot of us that are in the multifamily space have, analysis paralysis, where we get so bogged down with being in these minute numbers. And Alex says, "Hey, Max, we got to make this, how much of an education can we do on this video?" And I said, "Well, probably not as much as we'd like." But that said, that's the reason that if you're out and you're looking at doing a multifamily deal and you're somewhere in the space and you're saying, "Hey, I think there's this piece of real estate over here. I think this could be a good opportunity. How do I work on this?" And the best way to do that is to get connected with Alex, with Will, with a guy like me, and we can work on these things together, because in the multi space, that's how it's done. So, you shouldn't feel, if you're out there looking for a deal, like it's necessary for you to understand every aspect of it, because, man, I'll tell you, we never stop learning, and we always find, new things we've got to learn. And what we still find out in the business is that, someone calls me up on a deal in, Columbus, Ohio, and I'm not an expert on Columbus, Ohio. I might be able to underwrite a deal, but I'm going to have to find someone in Columbus who's going to be able to mitigate risk for me. And Alex, we had a little bit of a format. Do we want to go over that, or do you want me to just keep talking? Because I feel like
I think that the main things we want to jump this off with, I think what's most relevant to everybody's mind, like, what are you experiencing right now in the current market? Slowdown, shift, correction, what do you want to call it? Because a lot of people are still interested in multifamily right now. But with a rising interest rates market, where do you find things in the current environment, and how would you, kind of give us a quick rundown of what you're seeing right now currently in multifamily?
Sure. So the first thing I'm going to say is investing is good at any time. People who want to time the market, "Oh, well, I want to invest in 2023. Well, I'll tell you, you're probably losing 8 to 15% of your money sitting in a bank account for the next year with inflation if you're not investing your money. Okay. So just people have this kind of thought that it's better to wait, but the reality is with what inflation's doing, it can be damaging for your investment goals. What people should be doing is, when they're looking at investing, is making sure that the investments they're putting their money into have been risk adjusted. And what I mean by that is every asset's going to have a business plan. You're buying it at a particular net operating income. It's got a cash flow amount. That cash flow equates to what the price of the real estate is. And over the course of a 12, 24, 36, 48, 60-month hold, you're going to move it to a new level of income. It's going to have a new value. And within a longer term hold, which is where multifamily is, really what we're doing is the same BRRRR method that people see within the flip model. They buy the real estate, they cash out, refinance, and they have the building then paid back, majority of the money back to the investors, but still cash flowing and keeping the investors in, having equity in the deal. And within this time in the market, there are a lot of pitfalls. We're seeing those things. Interest rates are moving up. People are having to be a lot more cautious and diligent with what kind of loans they put on their asset. There are some guys in the market right now who are getting pinched as a result of floating rate loans, which floating rate loans for multifamily, when rates were really low, there wasn't much concern on rates shooting up as much as they have. And well, now we're seeing them shoot up, and all of a sudden, certain cash flow expectations they're expecting to be in the market are kind of getting eaten up by the fact that these rates have been moved up so much. So, that's kind of one very specific red flag that we're mentioning. We've also got, recession on the horizon. It's hard to, open up any news source and not see some articles that are about, recession. And the reality is the government's intentionally creating that. And we're just seeing that more and more. The government is intentionally increasing the Fed's rates so that they can create a recession. And they're saying flat out, they want to create unemployment. I could go into another conversation about how I don't think this really works. The last bull run, which ran from 2012 until current, was in many ways the result of the last recession. The government printed a ton of money to get us out of the 08 through 2010-11 recession. And what we've seen as a result of that is property values just increase wildly from 2012 up until current. And the reality is we're going to see that again. So we're going to see that again, and we're probably going to start seeing that the rapid increase. I'll call it end of 23, and shooting up past then. But any assets that are even being purchased now, it's a great real estate as far as being a supply constrained market. There's tax depreciation, and these risks that we're talking about are all things that can be mediated within a business plan. If you're worried about cash flow at the asset as a result of unemployment, well, then we raise more money for cash reserves to make sure that we can bridge that period of time where there might be, interruptions in collections for rent. If we're concerned about, interest rates moving up on a floating loan, then what we do is we get fixed rate debt. Maybe we have to hold the asset for 6 years instead of 3. But if we do that, then the investors understand that maybe instead of a shorter term hold that has more risk because you got to do it quick, you've got a longer term hold and not a lot of reason to be concerned because we're not planning on selling it, within the next 2 months. We're planning on selling it when the market's better. And that's one of the core things with multi versus flipping is that, we always want to make sure that we can hold the asset if necessary. With a house, everyone is aware if you get caught holding a house and there's a hard money loan on it at 9%, 10% or whatever it is, it can become very expensive to hold that asset. And multifamily, we're doing the same thing, but generally when we're buying them, we're making sure that we've got cash flow to cover, those mortgage expenses, on a go forward basis. So, so what do I think about the market? I think that real estate is all underpriced. I guess I'll say it like that. If I really look at the issues nationally with how much of a shortage we have of housing, how the supply chain is not going to get fixed. None of these issues they're talking about on national supply chain, they are going to get fixed. Costs are going to keep going up. And the reality is the US dollar is worth less. All of this Fed rate hikes, they cannot stop inflation. They printed too much money. They can create a recession. They can create aggregate demand reduction, meaning that if they make everything, they create a recession, people can't afford goods as a result of not being able to afford goods, then supply increases and decreases the price of things. Well, that's true, but that doesn't stop inflation. Not really. And when you look at real estate, it is the only hedge. So, when I talk to most of my investors about these topics frequently, and we've got a difference between what are considered retail investors and institutional investors. Retail investors are groups where you've got anyone who's in your network where they are the decision maker and they're able to put, I'll call it anywhere from 50,000 up to $500,000 into an investment. Institutional funds, generally a decision maker is going to be not the person who owns the money. It's going to be someone who is a steward of the capital, and they're going to check all the I's are dotted and T's are crossed to make sure that if they put money out, then it's a good investment. It's a good investment for their money that they're a steward of. But what that means is that those individuals are also more risk averse than they are actually looking at growing their money. And for that reason, a lot of those particular groups, many of them are waiting. Many of them are just looking and they're waiting. I don't think that's necessarily the right decision, but for many of those individuals, their jobs are more focused in risk aversion than actually trying to knock the ball out of the park. And especially when we're talking about some of these things that are things that we can, account for within a business plan for an asset. So those are the things that we're seeing. We will see some pain in the market. I think that's one thing that we're looking for in general is to find out, when those pain points are. And right now, we're starting to see it right now. And the Fed's going to continue raising hikes until we see more. That's the reality of the
Are
situation.
you underwriting more deals? Are you making more offers? Are you talking to more investors? What is it that your focus is shifting right now?
My focus is shifting to really working on a lot more of our investor relations work, trying to be out. I'm following, to be honest, your lead. Be out on social media, do more of those things. And, guys, and I got to say this, Alex has really been a good coach to me, in regards to doing stuff. So, a little bit of a nod on, on those things, because, I had a lot of really great deal knowledge, but, the investor outreach is a big new skill. So majority of my days, I probably spend half of my day every day on investor outreach, podcasts, social media creation, writing articles, getting things created so that when we have our next deal, we have more investors that we can very quickly move into the next opportunity. And that's the majority of where I'm spending my time. As far as deals go, we're only looking for deals where the seller is committed to selling within this market. There's a lot of sellers. Oh, if I can get my price, then I'll sell. We don't want to talk to those guys. We want to find the sellers who are saying, hey, no.
They need to sell now, regardless.
For whatever reason, they got to sell. And some of those, because a lot of the owners of real estate, when I say they haven't felt that blood in the market yet, they might not need to sell. And those are guys where, you're kind of wasting your time, or maybe you're having a call with them, trying to get them to take a lower number, but they're still, saying, well, I think my real estate's worth more. Or last year in 21, I got offered, this many millions more for the real estate. And reality is debt is more expensive now than it used to be. People's buying power is down. And if there's a bigger recession that affects, collections at an asset, then the prices of the real estate are going to go down even further for those particular owners, because everything in multifamily is based on the net operating income of an asset. Well, the way we price multifamily buildings is not as an end sale to an end user who's going to live in a home. We price it based on the creation of an annuity. You buy a piece of real estate for $1 million, and if it produces 50,000 income, it's got a cap rate of 5%. When we're valuing real estate, and because I was trying to think of the best way to sum up a quick way at your request to explain how we create value in multifamily. Within that calculation, $1 million into an investment, call it a bond, call it a piece of real estate, creates $50,000 in income. Well, that means the cap rate's 5%. But what that also means is that if you're looking at a piece of real estate and it collects 200,000 in income, well, at a 5% cap rate, which is what we're talking about, the real estate's worth $4 million. But if you increase the value of that real estate by increasing the net operating income by 50,000, well, then the real estate's worth $5 million. Okay. By adding $50,000 in income, we make the building worth an extra $1 million. And you can do that several ways. There's some assets we see, and they're just managed badly. They've got bad on-site management. They're not doing any good marketing. Their rents are, 20% below other properties in the market because they haven't had anyone who's paying attention to it. And we don't even need to go in and renovate the units. All we need to do is manage the building better. And there's other properties where we see that they've got their expenses that are just totally out of whack. They're overstaffed on payroll. They're not doing things they should. And as a result of reducing the expenses, we increase the net operating income of the asset by that same amount to increase value. And, so for guys who are looking in any market and you're saying, hey, and I think I've got a, multifamily deal that I think could work, the best rule of thumb that I would, tell anyone is, look for a building that has rents below market. That's the quickest thing you can look for. And if you see buildings on the same street, hey, that building down there has got really high rents. It's a, hopefully similar vintage. Maybe it's an 80s building and you're looking at 80s building and you see that building's got renovated units. The rents are way higher than the building that you're hoping to buy. Well, that means there's meat on the bone on that other building, because you see that there are rents that are higher than the ones that are currently being charged. And if you can increase those rents at the subject property that you're looking at, that's really the best way to figure it out. And then, knowing those cap rates per market is really going to be the question, because if we're talking about raising the net operating income, 50,000 to raise the property's value by $1 million, well, what does it cost to do that? Maybe it just costs the, change in management. All I'm doing is I'm putting in new management, a good property manager. I'm increasing the budget for advertising, and I'm going to clean up a little bit of property exterior, and maybe all those fixes cost $75,000. But if you're raising the net operating income by 50,000, well, then you've actually raised the value of the building by $1 million. It cost you 75,000 to get 925,000. And they're really a really quick analysis on those calculations. But within multi, there's a lot of facets: asset management, construction management, your debt structuring, making sure that you've got good tax people to be able to work through, cost seg analysis, make sure, you're getting these, the proper tax benefits for owning the real estate. All of these things are different player roles. So if you're out somewhere and you're saying, hey, I don't know enough about the entire market, I don't know all these different things. Well, hey, good news. None of us do. We get better at all of them. We get better at them, but we all hire specialists and we all partner with specialists within the industry to be able to fix those gaps that are within our knowledge base. So you've got some property and it's in a market where, Alex is located or where I'm located. And, you say, hey, I've got this piece of real estate and I want to figure this out, reach out. We're here to let people know to reach out. We want to be out in community with the other people who are in this industry. And most groups are happy to partner with deals that have, an opportunity to do so. And there's calculations you can look at, generally for deals that we work on, we allocate portion of the general partnership to who is bringing in capital for the deal. Meaning that, like, if we've got some person and he's just in charge of capital raising, we will allocate, funds for that person to do the capital raising. Same thing for the construction management, same thing for the asset management, same thing for who's doing the acquisition, same thing for who's doing the dispositions. And those roles can vary. So, so if you're someone in a market and you think you found a deal, call us and we can, work you into that particular, I'll call it a stack of partners that are within an asset.
Yeah, and there's a couple things I want to unpack about what you're saying to that. I'd like to I don't want it to go over some of the audience's head, because some of them might not have done a lot of multifamily, which is one big thing that keeps coming back up is the fact that there's a lot bigger pie. So there's a lot more to go around. So generally that's why you're dealing with a team of people. Obviously you do have to identify like what piece of that you're probably going to play. Like, are you bringing in capital? Are you going to be running are you part of the property management? Are you part of the construction management, as you said? Are you part of the financing of it? So it can seem a little bit overwhelming, but when you have 4 or 5, 6 people potentially that are helping, and some of these people will have a lot more experience than you do, and they also have a built-in incentive to help you understand the whole deal, or at least that's what you're looking for. So that way your kind of goals are aligned. I remember telling somebody here at the mastermind that, dude, I love this 18 unit. It's our biggest asset. I know it's going to eventually be, pay off and it's going to be a home run. It's been very stressful, but it didn't feel like buying 18 houses. It felt like I bought 5, right? So like I bought an 18 unit, but it felt like I bought 5 houses. Well, cool. I want to do more of that, because I tell my team that I would rather be splitting $500,000 with you guys than 50. Sure, the 50 is great, but these other deals have so much more upside potential as far as net worth, potential cash flow, all these things. And sometimes that is overlooked, because I've even talked to some not new investors, but not advanced, kind of intermediate, where they're like, oh, I'm going to go buy a 5 unit or go buy a 10 unit. But really they could be thinking about bigger. So that 5-10 unit might add, some $1,000 of cash flow to their net worth. It might add 100,000 to their, net worth, $1,000 to their positive cash flow. But a bigger building, which would take similar or maybe even less bandwidth, partnered up with someone, could add $300,000 to their net worth. That could add, $2,000, $3,000, $4,000 to their monthly passive income. I
would actually say potentially even more. I mean, because we're still, for larger assets, when I say larger, I'll say 20 million up to 50 million, these numbers get higher, once you're in for higher numbers. But what you find out is that, the general partnership, there's a difference between an LP and a GP. Now, the LPs are the passive investors. They have given their equity for the deal. And then the GP is the management staff of the asset. Now, the LPs, they can vote the GPs out if they want. If the LPs look at the deal and they go, hey, this building's not being managed, they can actually say, hey, you GPs, you're fired. You're not doing a good job for our money. So the GPs are incentivized to make sure that the LPs get paid first. And I'll try to not go into much in detail on this, but generally with investments for multi, there's what's considered a preferred return, where we offer the investors a rate of return that they get paid before we as the sponsor get paid. And the reason for that is that we want to make sure they get paid first. They get paid first, and afterwards, that's when the GP gets paid. And what Alex is describing is that GP payout, generally it's on the sale of the asset. For a smaller asset, it might be 100,000, 200,000. If it's a little bit bigger asset, it might be $1 million. It's a medium-sized asset, 20 million to 50 million, it might be $5 million. Okay. Now this is after the returns are paid to the LP investors, and the LP investors, if you're making 5 million, they've made more than you. So if anyone who's listening, they still got paid more. But the point is that, if you're talking about a $50 million deal and the property sells, now all of a sudden you're, a potential fifth partner in an asset that had a $5 million sale and you took a check for $1 million. Well, that's something that's going to get your partners involved and engaged. So, if you've got an opportunity for an asset where the gain is that big of a number, it's a lot easier to get those partners involved. And, the smaller assets, a deal that's under $1 million, the percentage might be high on the return, but there's just not a big enough number. If you look at an asset that's $50 million, well, all of a sudden the pie is big enough to get a lot of people engaged.
Yeah.
And that's the reason that, for me, and I'm always fine talking about this, but, I placed a lot of money from some very large institutions, and I was a W-2 employee and I was paid well on bonus, but I wasn't paid in equity. And I had to, really, take a big step back, move into, building up to buying some of these bigger assets like we used to buy within those larger companies. But and that's that ladder process of getting back to it. But we all get there. We just gotta get out of the comfort zone. And
yeah, exactly. And what's also interesting is that, there's a lot of investors that just stick to single family, or that maybe eventually just like they might step into some short-term rentals or something else. But I've also found it interesting that people in our own network that, in my opinion, are more successful than I am, have more going on, but yet they haven't gone into commercial, haven't gone into multifamily, haven't done that. And that was always my goal. Some people would judge and say, hey, you're just a house flipper, or how come you're not keeping these houses? But my plan was always to make a lot of money flipping, so that way I could own more commercial, more multifamily, those type of assets that can have a full-time property management company and all that. And you see that, that's one thing I'll share too, is that, property management is not sexy. It's not fun. It's like, there's it's very tedious, it's very time consuming, but somebody needs to do it. And as you said earlier in the conversation, there's so many property owners, especially self-managing property owners, just kind of mismanage the property, or it's cash flowing enough. They've owned the property 10, 15, 20 years. And those, they're just kind of tired landlords. And there's golden opportunities there. And we're going to see some of that. Right now, I think we're still seeing the sellers be, even on my side of things, I'm a seller. I'm reluctant and I don't want to concede that the market has shifted, or like there's a lot I want to give back. It's like we were joking in the car yesterday with like negotiating with the party and saying, oh yeah, okay, well then let them walk. And I'm like, no, don't walk. I was like, let them walk. We're keeping deals together right now. But it is one of those things that until we made the decision and say we're going to be buying a multifamily unit this year, like we were just sitting on the sideline and just not doing it, and then finally we jumped in. I'm so glad we did. Whether we do more in Arizona, or we do the same size, or we go bigger, we're still determining that. But I'm super grateful for your help, for Chris Bergman's help, for everybody else, because now we actually understand what you meant by, like, I remember when you told me, dude, like, you're never gonna want to go any smaller than this.
Never want to go back, right?
Yeah, because that's almost the same amount of work is going to go into buying a 50 unit as buying an 18 unit. So you're probably going to want to go bigger in the next one.
Yeah.
Now we'll see how that turns out because of what's happening with interest rates. And it seems like it's hard to get a good deal right now, but are you doing anything different to underwrite deals, or what kind of advice would you give right now just regarding underwriting? Because I think that's one big thing for beginners. Like, how do I underwrite a deal without getting into these like crazy numbers that I'm not that familiar with either? What do you recommend there?
So two things on my website. In about 2 weeks, I hope, we'll have an actual 6-course class on underwriting multifamily. So people can literally go in and see, how we underwrite deals. And to anyone who's interested in looking, go to the website, fill out a form to get us on your give us your email address, and then we'll let you know when those videos come out. And we go on a very granular basis. We break them up into about 15-minute videos so that it's not overwhelming, but, it breaks it down by section, unit matrix, stabilized, in place, T12 income, stabilized expenses. We go through all of them, section by section, including, the renovation of the asset and, cap rate analysis and debt and the cap structure across the board. And these things take a long time to learn. So, right now what we're doing is we're really beating up deals a little more than we used to, because we're kind of going in this environment where it's going to be rougher seas. So, there's a lot of news that was about how, rent growth was 20% last year in many, locations in the US. And, we can't underwrite a 20% rent growth, year after year. That would be something that would really, cause it would make your numbers look fantastic, but whether or not that's accurate is kind of a different topic, So, we're increasing our expenses at deals because we got inflation that's affecting, though that particular, it's affecting our, cost of running the asset. And we're making sure that, the deal has the ability to refi if we need to, and just make sure that, last year we could underwrite a really low exit cap and, most likely be fine on a deal. In reality, things were just moving just straight up like this. Now things are going the other way, and we have to make sure that the deal is protected. And when I really say deal is protected, make sure it covers debt service. At the very minimum, deals covers debt service. And, there will be pain in the market for a lot of guys, but as long as that debt service is covered, to be honest, everyone's going to be fine on the backside. That's the reality, because there's a lot of, current, people panicking over, stuff. And it was Warren Buffett had a statement once where he said, if you go out and you buy a car for $80,000 and someone the next day offers you $60,000, are you going to freak out and say that you overpaid for a car, or just say, hey, someone just offered a price for something, it doesn't change what you paid for it, or recognize the value of it? And the reality of it is it's the same thing for real estate. All of the values are, if you look at 12 months from now, 24 months from now, are going to be significantly higher than they are right now. Okay. So everyone just has to bridge that period of time and be aware within their underwriting to be selective with their target rents. Are the target rents the accurate numbers? Can we really say that, whatever rent growth you project is accurate? Be accurate with the expenses, be accurate with the income projections. Those are the biggest things. Other ones, we make sure cash reserves are underwritten accordingly so that you've got the ability to, cover any income that's cut short by some rental collection issues. And make sure that on a refi, if you're looking at a refi, that you're either sure you can get that refi or just putting long-term debt on it. And, in those factors, when you look at them all together, last year, we were probably underwriting, 14 to 17 IRRs on deals. Generally right now we're starting about 17. And the reason for that is because, a lot of investors don't really want to look at some of those deals right now unless they have a higher return. I don't think that's the accurate standpoint for a lot of those investors. There's going to be a lot of people who are going to have missed the boat because they invested late. I mean that. There's going to be a lot of guys who are going to look in the rearview mirror. They're going to say they waited too long. They're going to look at getting back in, and the inflation that we're already recognizing. I mean, if you really want to look at inflation and what it's done, and you look at an 8% growth, it's way more than 8%. That's just what they're looking at current CPI. But in 2 years, 3 years, 4 years, 5 years, it's really going to become clear how wildly damaging not investing in real estate has been for all those people. And I mean that. In fact, it's a little bit of, I'll call it, battle cry a little bit. If you don't invest, you're going to get left behind. I'm being dead serious. It's going to happen if you don't invest. So, that's a little bit on my soapbox, but okay. I think it's appropriate.
And I know that you're currently working on a couple of multifamily value add plays in Southern California, and you have one in Arizona as well.
Yeah, we've got one in Arizona, we've got one in Southern California, and then we're currently working on another project right now in Des Moines, Iowa, and then we've got another asset that we're looking at in Texas. And with all these deals, we're working on them. We're hoping we can get something put together with the sellers, and we'll find out what that looks like. So a lot of sellers are still trying to get that last eke of value out. And the reality is, the market's going down. They're probably gonna have a hard time, selling the real estate for the same price if they're committed to selling. If they don't sell it now, it will be worth less in 3 months, and most likely a little less after 3 months after that. And then second half of 23, we'll probably start seeing, an increase in values again.
Yeah. And have you seen any significant change into what you underwrote your original 2 deals that you're working on now to now? And then,
I wanted to know that too. Like some of those deals that you got into before, has anything shifted on them now, like, or anything that's, dramatic, right?
No. And the reason that they haven't shifted much, so what shifted a little bit is, our current refi that we're expecting on our Riverside asset. And I'm not worried about that asset. If we didn't do the refi, it was still going to perform fine. And we underwrote that, within our numbers. When we first got that loan, we said, hey, if we're unable to refi for whatever reason, can we keep the existing loan? And the answer was yes, we could. So we knew that, and we were like, okay. So that was our kind of making sure that we were going to be, addressing that particular concern. And And, and if we were looking at selling this year, well, then we might've got pinched. If maybe we put the debt on the asset 3 years ago and the debt is now coming due and we didn't have, I'll call it at least 4 years. We've got at least 4 years on that asset to be able to work through, temporary issues that are going to affect us on that deal. Right now, while we're still working through some of these factors, our target rents we're signing leases above those current target rents. And our refi, we probably won't be able to refi for the initial number that we were looking at refining, but it'll still be enough to get us out of our current financing if we need to. And if we don't need to, then we're fine with the existing debt. So, and then our Phoenix assets, that one, we bought a 5.4 in place cap that was mainly had government subsidized tenants. And as a result of having those government subsidized tenants, the majority, hey, Will, I'm so sorry. Are you talking to me?
No, he's muted.
Oh, he's muted. Okay. So, but the majority of the subsidized tenants, we're still, the government's paying the rent. So even if the collections have been fine, but within that property, if the market sees a big hit to collections and rental rates, start dropping, technically the government's still paying our leases for that asset. So, and that was a benefit that we saw when we bought the property. And it was kind of it was a rough asset. It really was. It wasn't something that we looked at and said, oh my gosh, this is such a sexy property. We kind of saw it and we got, this is kind of rough. But, but we knew we had insulated, rent collections that were going to be, taken care of. And then assets actually performing really well for us. So we were really happy to see that.
Awesome. Well, I think we did have some questions from people that were going to be attending the webinar. So why don't you see maybe we can...
And also, yeah, if you guys who are on the webinar currently have any questions, I was just going to say there's a Q&A feature right down at the bottom here of your screen. If you guys do have any questions, for Max, obviously, like we said, you can tell the guy is, really, really smart. So we'll kick off a couple of these, Alex. But then if anybody live on the call has any questions, feel free to go ahead and put those in as well, right?
Yeah. So I think one big question that I like that the registered attendees asked was, hey, Max, what red flags do you watch out for on these multifamily deals?
So red flags I watch out for, within any red flag that we see, we want to address it within the business plan for the asset. And what that means is that every deal we buy, we are custom writing a business plan and we're going to say, all right, this is what we're going to do to it. We're going to change this. We're going to renovate this. We're going to change over management, whatever it is. But the red flags are things that you should always be looking for. And within any of our offer memorandums, we have an issues and mitigants section, and that could be anything. This property is all 1 bedrooms. Is that an issue within the market? If you have all 1 bedrooms, you don't have them divided out by 2s and 3s, and that could be an issue. Could also not be. What would, is there concern about this particular property? There's the deal that we underwrote that was in Kansas City. And we found out that purchasing single family houses in that particular market, the submarket where this was, were like $60,000. We found out that a mortgage payment was about $450. We were looking at target rents for the asset that were about $700. That made us look at the deal and go, all right, well, we need to adjust this in our price. So we reduced our price to a number that we felt, could accommodate, that particular amount of risk. But those red flags, those are very specific, 2 specific examples, but, the red flags are really the ones that I kind of mentioned on this call. And we want to make sure that the downside risk that we have can be met with, is at least looked at. And if we don't have an answer for one of those things, generally we'll kill the deal. If we look at something and we go, all right, we don't have verification of these target rents. Seller is saying that they're renting their 2 bedrooms for $1,000 a unit, but we did a rent survey and I don't see any two bedroom rents anywhere in the market. And on his rent roll, he's renovated these units. He said his market rent at $1,000, but the highest one he signed was $825. And those go into a little more.
Those are direct red flags, right? Like you're not able to verify information, and that's typically not a deal that you guys are going to want to get into, right?
Yeah, that's correct. But that's also something that we can address for in price. If the rents are lower and you, I don't want to say, call the seller out, but, hey, we're looking at this particular loan for the property. The appraiser is going to go through and he's going to ask the same thing we are on these target rents. You're saying we can rent these for $1,000, but it doesn't look like we have any verification in the market. Can you show us where there are,
show us that building where you're seeing that rent? Because maybe it's not on our, maybe it's not on our database. Maybe they haven't updated the rents. But if you have somebody that can show us that, let us know.
Yeah, exactly. And because, and if they can, if I've missed it, then I do want to know that. And if they can't, well, then they're going to have to actually recognize that, their building might have been worth a little bit less also as a result of that. But those red flags, the underwriting, and a lot of guys who've been in the multifamily space too long can get a little bit jaded on deals, because it's almost like having, history of bad girlfriends where there was some little deal that had some issue on it, and there was that one tenant who had caused that problem at that property, and that other property had that roof issue, and that other property had that one particular city ordinance law that really caused us an issue. And after 20 years, 30 years, 50 years of working through these things, you get these old wise investors who, man, they'll point out everything, every red flag, and they also might not do any more deals because they're just they become overly risk averse. And all of us have to be able to within this industry work through problems, because every deal's going to have problems. Every deal is going to have an issue of some kind, and we just have to be able to work through them and make sure that we're doing right by the investors. And I'll really say pointing out the red flags. That's the biggest thing. Is, what red flags do we look out for? All of them. But then we also have to go out and make sure that we address those things.
Good stuff. And I know, like you said, like it's pretty basic at heart, right? You need to verify certain things. And if you can't, those might be something you want to, move on from. I think, for me, when Alex and I were looking at our 18 unit, right? Like those are some of the same things that came up, right? Like, can we verify that this is going to rent for more money?
Mm-hmm.
Well, that's probably one of the easiest ones, right? You pull a couple other property management companies, you pull a couple other apartments.
Yep.
Alex and I even went and did appointments at other apartments, right? We were out there and we were like, hey, let's go book an appointment at this 2-bedroom, 1-bath.
Yep.
Let's go see what their property looks like. Let's go see what the management process looks like. Let's go get our hands dirty, right?
You did everything you were supposed to, which is the reality of, for anyone who's looking at investing, what Will is describing is the sponsor you want to know did all these things on behalf of the investor. Those are, it's wildly important.
Yeah, exactly. And there's no problem with investing out of state, but that doesn't mean that you shouldn't visit that property, go to that state, and perhaps, especially if it's, a new operator or somebody else that you're partnering up with, or a new market that you're looking to invest in, do your due diligence, go out there, see for yourself, look at the asset, verify. Those are things that, I spent weeks in Arizona, just checking the market out, talking to investors of all types, and just getting a read on it, getting understanding of the market that you're investing in is critical in real estate investing. It doesn't matter. I didn't do deals in Hawaii for the first 4 months of me being there, even though I was so thirsty to get out there and looking at deals and make offers. But because I was working on LA stuff and Southern California stuff, I just didn't have the bandwidth. And so I think, there's also a lot of importance that people need to know what they're investing in. And now I'm bullish in Arizona, where I understand the market. And the old Californian in me was like, oh, people can't hack it in LA. They can't, handle the pressure. Let them leave to another state. It was just this ego talking. But then after I went to Arizona and I saw, the nightlife, I saw the date, I saw everything that it has to offer. I'm like, dude, this is a cool city. I can see why people are moving here. There's a lot of jobs, great infrastructure. Now I'm not just randomly investing in some property that I don't know, but I actually understand the market. But that's through these connections and networking and spending the time there.
You sunk your feet in.
Yeah, exactly.
Yeah.
And that's something that I don't really think enough people do. They just want to this passive investment. It's not really passive. It can be there's a big form of passive, but it's not 100% passive. There's still a lot of activity on your behalf to make sure that your investment is going in a great place, and you're going to get, what you're investing in. So do we have any other questions?
We have a great question actually that just came in from Adriana. So Max, she's wondering if you acquire deals that are under RSO. And for those of you that don't know, RSO is rent stabilization ordinance. So is that a type of properties or assets that you guys are currently looking at?
No, in fact, rent stabilized assets are ones that we particularly don't look at. And I'll make there's difference between rent stabilization and rent control. And rent control is where government regulatory body has said, hey, you cannot increase rents more than a certain amount. And I could go into why that's a death sentence for cities if they decide to start implementing those things. But generally what happens is you're only able to raise rents once that tenant moves out. Then you can raise rents to market. Rent stabilization says that tenant moves out, and whatever the new tenant moving in, you still can't raise the rents. And, and that is, something that's really, it really forces an owner not to be able to increase their rents at an asset and keeps them potentially very below market if rents keep moving up.
And that obviously deters an investor like yourself that's looking to value add and get up to that higher valuation.
Yeah.
It's tough to do that if you're stuck on the rent portion, right?
That's exactly correct. And within a rent stabilized asset, I wouldn't look at a deal that was rent stabilized. There are some markets in the U.S. where people want to own legacy holds. There's some assets in West LA that are new builds that are rent stabilized. So, buildings built and, it's 2-bedroom, 2-bath units at $6,000 per unit, but that's it. That tenant moves out. There's a CPI increase in rent. So maybe you can raise the rents by 3% or something per year. But those types of policies, not only would I not rent, buy a building that's rent stabilized, I would also really have a hard question of investing in a market that has rent stabilized buildings, because rent stabilized buildings and buildings that have rent control, I hate to say it, there's a lot more crime in those markets. There really are. And as a result of there being a lot of crime, this is a little bit of a different topic on philosophy for investments. There are good deals in any market, but you have to be experienced within those markets or knowledgeable about them enough to have followed enough transactions, check on rents, have, boots on the ground to be able to really evaluate, what makes a deal a good deal. And for some markets that have rent stabilization, rent control has really increased value of real estate within California. In reality, they've reduced supply by enacting rent control. And what that's done is increased rents within the state of California. They did it to try to make rents more affordable, but in reality, it really does the counterbalance of that, does the exact opposite of that. And rent stabilization is a similar process. So I shouldn't say I would invest in a market, because if you're working in some of those markets, you do have an ability to buy a market rate building that does not have those issues. I do know a guy personally who bought a deal in Brooklyn, New York, and there was nothing on the books, nothing on the dockets for any kind of rent stabilization to be implemented. And all of a sudden, the government body within where his building was purchased, they said, "Hey, rent stabilization, we're putting this in." And it was a really hard thing for him and his investors. It was an unfortunate situation.
Yeah, so we also don't really invest in any of those. We get presented them all the time because, being in Southern California, city of LA has a lot of rent control, and so we see them. And we've negotiated cash for keys with certain tenants on smaller multifamily and certain deals, but when it really comes down to it is that it's not landlord friendly state, California and Hawaii, to the states that we operate in. So we don't typically look for cash flowing or long-term assets, multifamily, and as much as we're looking for single family fix and flip, single family burrs, things like that. So I think every market there's great opportunities, but we decided on going with Arizona for that reason, because we could see that it is much more property owner friendly, and there's
business friendly, property friendly. Yeah. And, and Arizona has really seen a huge increase in value as a result of what's happened in the state of California.
I think Ken McElroy said this in the Limitless conference that we were at a couple of months ago. He's like, money goes where it's treated best. And that's what you see.
That's true. That's very true. When you say that, that's very true.
It's like, it's treated best in a lot of these other states. And I love California, I love Hawaii, but man, when it comes to like being a property owner, we have a house that we have in the San Fernando Valley in LA that we bought over a year ago, and the tenant hasn't paid, hasn't let us in, and has been working us and finessing the system. And it's just egregious. I have no problem working with tenants that are going through problems that I'm human. I want to make sure that I'm understanding, but man, there's things that they get away with in California that it's egregious. It's not business friendly. So yeah, to answer that question, we also do not really invest in those unless it's a screaming deal and a vacant unit, which is very unlikely in California most of the time.
Good stuff. Well, guys, I'm gonna go ahead and add some more of our attendees in here. Just get a chance to kind of share the stage with them. And obviously, we had a couple questions come in already on the chat and got those answers in. But, if anybody joining in on screen has any other, questions or any feedback from Max or additions to the conversation, please feel free to join in here. As we do that, though, Alex and Max, would like to kind of get your closing thoughts on if somebody in the call right now is new in multifamily, we talked earlier about the different team members, right, Max? So what would be a great place for somebody to start if they were looking to become a team member in a multifamily group?
For myself, if you're looking to get into multifamily, I've got a couple of different guys that are located within the US, and I work with them on their deals. They call me, we review their deals, we go over them together. We have a handshake agreement that if they put something together, that we're going to be included, with them on the pursuit of the asset. And we bring a lot to the table for that. We're going to bring the construction management, we'll bring capital, we'll bring the construction, not construction, but the debt structuring, and all of the things we've kind of mentioned on this call that can become very granular, to that individual. And those agreements are not, they're not longstanding. We find one deal, we work on it together, and no one's, no one's on the hook, but there's a couple of guys I work with in some different markets, and we're evaluating deals. And I would say that's probably the best way. I do believe it's a value to have a mentor within the multifamily space. And I don't think it's a requirement. I think there's a lot of guys out there who have met, who are very successful. Some guys who started in their early 20s just buying multifamily deals, and they learned it by, School of Hard Knocks. But if you want to get into the space and all of a sudden, you find a deal, but you need $1 million, well, having that team's going to matter, very quickly. So, it's easy to reach out to, me. I'm easy to get on my website. If you've got access to other people who are in the multifamily space, same question. Hey, I want to partner with you on deals. I want to look at how to do these things. Most guys who are in multi at some point, they had, a coach or someone who worked with them. And, I had my first coach, was a sales coach, wasn't a real estate coach, it was a sales coach when I was in my early 20s, and it was wildly beneficial, and the same reason why I like partnering with guys who know more than me about, whatever topic it is, cost of learning is expensive, and sometimes
they already took those bumps and bruises for you, right?
Yeah, I took, exactly. That's a very good way of saying it. Yeah.
I'll definitely echo what Max said. Is just that, in many ways, Max and Chris, that's also leads the multifamily call for the Future Flipper program. Have been great mentors and people to lean on. Just people. You think you have these questions that just come up, and you're like, oh, well, because single family, in many ways, is much more simple, right? It's just like the houses. But when you're talking about multifamily, there's just much more complexity to it, and then you need to be able to ask those questions when they come up. And these are bigger deals with bigger stakes and take longer to develop, generally speaking. So, you need that sounding board. It really is super valuable. I've been on phone calls with Max for like 20-30 minutes, and the guy has just enlightened me with I've learned so much by just running questions by him, running scenarios, asking specific questions based on my scenario and my desire and my goals on multifamily. But as I mentioned earlier in this call, I'm so happy that we took that leap and went into the multifamily, because otherwise we would just been like every other house flipper out there, just sticking to just flipping houses forever. But
I don't think it was a shiny object syndrome either, right? Like you hear that sometimes when you look at different asset classes, but like you said, Alex, like we jumped in, we got our feet wet, like we really did what we were supposed to do to get into this property, right? It wasn't a quick decision. It took months long research in different markets, and then we kind of finally made that jump. So I agree. It was a big move, right?
Yeah, exactly. And so I think it's inspired some people, in our circle. Hey, I want to get into multifamily as well. It's also strengthened the relationship that we have with one of our key principals that was on the loan, Ethan Anderson, that's on our other deal in Maui. And so, having partners and other people that could add value to these transactions as you grow that. I fully anticipate doing another, deal, whether it's multifamily or commercial, some stores. I'm interested in storage as well, sometime this year or next year when we're getting this one to the finish line. But without taking the first leap of faith, you're not gonna, everybody wants to get into multifamily, but the reality is that you need to kind of, it's different space in single family. It's better that you go, you start looking at how you can break in, but it's more of a team sport. Then I think you can go at it alone and be an individual, like kind of lone wolf a lot more when it comes to single family, but not the case of multi. So reach out to Max. Yeah, you have his info. He's a wealth of knowledge. Thank you for your time. I have nothing else. If anybody has any specific questions, though, I'm sure Max has a couple more minutes to answer your questions.
Sure.
Cool.
Cool, guys. Anybody, any questions? Oh, go ahead, Ed.
Well, Adriana raised her hand first. I was gonna let her go. No.
Yeah, I'm here. Good afternoon, guys.
Hello.
Hi,
Hey,
how are you? Thank you for the information. This might be, I have a question, but it might be kind of dumb, but I'm new to this, so I think this is the way I will learn more. Do you guys use DSCR loans?
So you say if we use DSCR loans, your DSCR is your debt service coverage ratio. And technically every loan has a DSCR. And what that means is if they want to know how much you're covering, your net operating income is covering your loan balance, the cost of your loan. So if your loan cost is $100,000 a year, they want to make sure the net operating income is $120,000. $120,000 is 20% higher than your $100,000 loan cost. That would mean your debt service coverage ratio is 1.2. If your debt service coverage ratio is 0.8, it means you are 20% short of covering your loan for the property. So, and within DSCRs, that particular metric, that is a metric that's used between calculating out, if your property really qualifies for agency financing, which is generally considered to be fixed lower rate debt, or bridge financing, which you can get out of very quickly. And when I say get out of very quickly, if you sign 10-year money on a deal and you get into it for 4.75%, well, that loan is going to be encumbering that property for 10 years unless you pay a very hefty prevent penalty, versus a bridge loan. All right, hey, we got a loan, it's for 12 months. And at the end of that 12 months, we're going to refinance the asset at a cheaper rate, but we had to get in at 8%. Well, the DSCR for the agency financing most likely will be, they'll make sure that's at 1.2. What that means is that they might only offer you 50% on a loan to value. They might not, on a bridge financing, they might offer you 70%, 80%, more money to get your work done at the asset for stabilizing it, renovating the units, fixing management, fixing whatever problems that are there. But on agency debt, they'll give you a cheaper rate, but it will be, they'll give you less proceeds, 40 to 50% on the deal. Does that answer your question, or did that go?
Yeah.
Okay.
Yeah. Thank you.
Great response there, Max. Ed, let's do one more quick question here, and then we'll go ahead and get things running here. Go ahead.
Yeah, mine's quick, and I appreciate all the info and setting this up, guys. When you're working with people to bring money together, what is the preferred interest you're offering? Do you sometimes give combination of equity and preferred interest? What are you seeing people prefer, or investors? What's the pitch kind of?
So we very specifically offer somewhere between a 6 and an 8% preferred return. And then we do a 70-30 waterfall after that. And for any investor, anyone who's on this call, what that means is that we say, all right, investors, we're going to offer you a preferred return for this particular example, say 7%. And then after the investors receive their 70%, we have a waterfall split where the investors receive 70% and we as the sponsors receive 30%. And that's the way that we generally structure our investments. An investment with a higher amount of risk, we might have the preferred return be 8. For an investment that's more secure, we might have the preferred return be 6. Those numbers generally are calculated out when we're writing the business plan for the asset. I was mentioning that every business plan has its own, every asset has its own business plan attached to it. A deal that is heavy in the value add space is going to have a different set of returns that we're going to try to target than an asset that maybe is a core plus asset where we buy it and maybe doesn't need any work. Maybe we buy it and it's already got the highest rents in the market. We don't have to do any renovation for it at all. Maybe we don't even have to change out management. Well, if that's the case, it's considered a much more secure deal, but also
less risk, right? You're not changing management. You're not updating the property. So those are, if you update the property and something bad happens, something worse happens, that's more risk. But if you're not having to do that, that's less.
That is exactly the case. That's exactly accurate. And so
and just so you guys know, we do the same thing on our single family. Like when we bring in a private money lender on our single family deals, it's 7 to 12%, which annualized is 14 to 24%, and it just it depends right Max on the risk. If we're going in and having to knock down walls and add bathrooms, that's more risky than if we're going in and just doing a quick quick turn, right?
It's more risk and it's more work. Because all of a sudden, even the sponsors are going to look at it and go, gosh, how much are we bending over backwards for, a smaller amount than a bigger amount. So
the 70-30 is on the cash flow?
No, on the returns in general. So we're going to look at the returns and we're going to say, all right, so someone gives us $100,000 and it's for a I'll call it a 3-year hold. So we're going to expect to give them $7,000 per year on their return. That might not be from cash flow. That might be from, equity in the deal, and it's going to accrue year after year. So by the end of year 3, that investor should have $21,000 either paid to them via cash flow or be owed that money to them on sale. On sale, we would then pay out that money, $21,000, and then whatever is left over after that, we would split with them 70-30. But generally, if we've got a cash flow, say there was a 4% that's paid out per year, well, we wouldn't owe them the 7 because we'd have paid out 4 for those years and then owe them still a 3% delta on that.
That makes sense, because right now that's one of the things I'm trying to do or working on is raising capital and whatnot, because a lot of deals I'm seeing right now, because I focus a lot on multifamily, are loans that are assumable. And the only way to bridge the gap between what the leverage on the current loan is and what the seller's asking is through private capital and seller financing.
Yeah.
So I have some in Phoenix area, Arizona, that's kind of the structure I'm setting up. So just like, okay, now what do I need to know how to underwrite it so I know what I'm offering to them. And I'm just curious how everyone does it, has their own strategy. So
yeah, I mean, you nailed it on the head. There's going to be an amount that, especially if you're assuming seller financing. So what happens often in the market is, hey, we've got the seller, he's willing to let us assume his debt. But what you might find out is that the price he's willing to pay, he wants you to buy the deal from him for, means you might have to still raise 70% of the equity. $10 million deal, you got to raise $7 million. This is very real in the market right now. There's a lot of sellers who want that kind of return, and maybe their in place debt is 2.75, maybe it's 3. You look at putting new debt on it, and all of a sudden you can get financing that maybe is $5 million, $6 million, but the rate is now 6%.
double.
So yeah, double. So there's this delta between how much proceeds that are being given and the rate. And and to be honest, you nailed it on the head. You could either bring in preferred equity, or you can raise more money. Pref equity is a method by which you've got a preferred equity stack within a deal. So generally, when you're buying an asset, the lender has the first trust deed, and then the equity is in second position. Within preferred equity, you've got an equity stake that technically is paid out before the other LP investors as a result of them, putting in this additional amount of capital.
In my scenario, they'd actually probably be one notch lower, because I have the assumable, now I have the seller carrying 20%, and then where the remaining 20%.
Yeah. So and that seller, you could write him. I mean, that could, a second and pref, you could view them as the same thing.
Yeah.
Because technically you've got this individual who you're still paying back first for everyone else, but it's still after the actual loan.
Yeah. Definitely appreciate it.
Good stuff, guys. Well, Max, I know we appreciate your time. Appreciate you jumping on here. If anybody needs to connect, obviously you can connect with Max on the side. The guy has a wealth of knowledge, a really smart dude, and has been doing this for quite some time. So, again, feel free to bring him your deals. I know you said, earlier on the call, like he's open to partnering with people and, being that team member for you. So I think you guys should take advantage of that if you have something that makes sense. Cool?
Yeah, please reach out.
I'll be reaching out, Max. Thank you so much, guys.
Awesome. Hey, Alex, Will, thanks so much for having me. It's been really great.
Yeah, thanks, Max. Everybody, we got to get going. We got to go back down to the conference. Thank you for your time. Go out there and take action and keep being amazing deal makers. Let's go.
We'll see you guys on the flip side. Let's go.